Hey Lynn, the property's getting older, my repair cost goes up, but rent is not going up, property tax is going up. What do I do? Do I sell it? This morning, I actually got a call from my long-term investors. Her name is Amy. It's not a real name. Amy had a dilemma, which a lot of investor has. They own residential investment property for almost 10 years, 8 years. They're like, hey Lynn, the property's getting older, my repair cost goes up, but rent is not going up. Property tax going up. What do I do? Do I sell it? But I missed the opportunity, sold it 2 years ago, making so much higher. If I hold it, well, my rent is not great, cash flow's not great, but I'm making good money because I bought it 8 years ago. So I wrote her a long email. I want to explain to our investor. I want to talk to you about this too.
Absolutely,
Yeah. So in this situation, what do we call this? What do we call the state of the investors at?
Yeah, I think we're in the beginning of a new structural shift in the cost of money and the cost of capital, and therefore the yields that you can generate with any investment today, right?
Right. So I call this ad that she's at the stage where I had a diminished return, meaning she bought the property 2016 for 260,000. She could have sold it back in 2022 for over almost 700 or 600, but now probably can sell for 550. She still got what 200,000 capital gain. It's still good investment, but because of a different maintenance, because of higher insurance, lower percentage rent, that's why today if you look at the overall investment period, she probably get 9% returns, but the return's gonna get lower, lower, lower from this point on.
Yeah, and I think that the foundation there is during those high valuation periods, interest rates were at 2.5% to 3%, right?
Right.
Which is exacerbating the value of these assets tremendously. Now we're normalizing for the next decade into a very different value band, in effect, right? So we have to acknowledge that at this point that has changed.
Exactly. What do you think you can foresee from this point on?
Yeah, so being an equity investor owning your own real estate is fantastic, right? It creates strong returns over time. And in this case, most single family homes and duplexes and fourplexes, things like that, create low double digit returns over time in stabilizing and growing markets. In this case, now that we're in a market where we're effectively reversing the capital markets um, plan where things are getting more expensive from a capital markets. Cost of capital has gone up from 3% to 7% in this market. What we're seeing is investment returns are actually going down into the upper single digits at this point, right? So like in Amy's case, 9%, very common return. What we'll say here is, given the market that we're in and the fact that cost of capital has gone up, now is a very interesting time to start converting your assets into better risk adjusted returns in two dimensions. One is you can lower your risk by going from equity only to now debt investments that also generate very similar returns. For example, our fixed rate income products already generate 9% and 10%, right? So if you invest in our fixed income products, we're already at those rates of return, but now you don't have equity risk. You don't have to worry about insurance, taxes, repairs and maintenance on those homes, right? Now, the other thing is, in addition to a lower risk adjusted return, we also have opportunities to create much higher returns going forward by effectively investing below market value, like in the case of distressed land investing or distressed asset investing and things like that. That could generate low double digit returns. But if things go well, because we structure deals in a very specific way, if things go well, sometimes those returns can double. And so now we're talking about low double digit to mid double digit to sometimes even north of 20. Right. So you can structure deals in this environment to go from a 9% return to a much healthier return over time.
So what you're saying is, it's a good opportunity to change that to what to high yield investment vehicle or product, right? Or just totally change it to a distressed situation like we just talked about
Absolutely,
today.
yeah.
Buy low. That way you have a way to buy in at the right price below market. That's how we can. That's exactly what I would advise her to sell this good investment. I call good to great.
Yeah.
A good investment for her over the years, but turn that into a greater investment.
Absolutely.
So don't just sell it, pay for the tax. You could, right? But there's many other ways. What, 20%, right? So it's about 40,000 capital gain. What do you do with it? We have an opportunity zone project, and you also could do 1031 exchange, do DST. There's many other ways. Don't think about, just think about how much money you will earn or you will exchange to, but also think about how you defer that tax, have some sort of tax solution.
Absolutely. And when you think about it, think about your investing journey as a holistic portfolio over time, right? There's the periods to accumulate wealth, value, then there's periods to convert value into cash flow, and then there's times in life where when we're ready, it's time to start transferring assets from asset to asset and from asset to generation in a tax efficient manner. And we have all of that in our ecosystem over here. That's how we handle it.
We should actually talk to folks about the arc of your investment portfolio. And remember, the tax benefit definitely is on top of that.
Yeah, for sure. We should. That's for a separate video all on its own.
Absolutely. We're excited about this, bringing all the knowledge, experience, and our success to our investors.
Absolutely. Help them on their journey towards success.
Absolutely. Love it. So we have a solution for you. Either join us for our fixed return project or fixed yield, or some good equity project, or many other asset you could purchase at distress or below market.
Absolutely.
Yeah.
Yeah. Sounds great.
Sounds great.
Yeah.
Thank you. Happy investing.
Happy investing.